what kind of use cases then do you see? Give me like we've talked about, maybe it's like a community bank. It's maybe like an error-free bank.
Yep.
But you also said actually it might be more like a business application.
Well, no, not as so. I was saying more like if it gets traction,
Right.
it could be from like the business angle. But there's, well, I guess what I would say is like one of the primary angles is we have communities and community finance in Africa. There's a lot of microfinance. What I think could be really interesting is like, let's assume maybe a path to this in the next decade. If you have enough of this technology garner enough attraction, what do people want? Well, they want to use Bitcoin for its medium of exchange function, not for its store of value function down there. Despite the idea, it's just the volatility is too expensive, but nonetheless, like the Lightning Network for remittance payments and for general transaction costs is quite a bit cheaper. In fact, federated Ecash transactions would probably be even cheaper than that too, which is interesting. But let's just say it's Lightning. So like that's valuable for people to be using, but then it comes down to, okay, well, we got the stability of the asset now, and people want dollars for kind of their store of value function because of that. So maybe you could have stable coins get integrated into the system. That's certainly possible. What I think is also interesting is like Fedimint did a hackathon, and there's this idea of like stability pools. And, these kind of ideas existed in crypto in the last cycle, but it's like you pool liquidity together and you set up effectively what's like a derivative contract between two parties. And it settles based on a market price. So like all that means is like you can find stability by finding buyers and sellers in a market to agree to pay you a certain amount of Bitcoin based on a price. So like everybody pools their liquidity. I say, I want to have stability in my Bitcoin at 24,000, and I lock that price in for the next epoch 10 minutes later. And at the end of that 10 minutes, if the price of Bitcoin rose to 26,000, then I pay the extra amount of Bitcoin to the guy on the other side who took the risk, and he didn't get stability. He increased his volatility. So like basically there's this idea that they could use the programmability of this system to create things like stability pools that could actually create stability within Bitcoin. You pay a fee for it, and that's a huge question. Like, this is a new idea. So like maybe it's way too expensive. Bitcoin's too volatile. People have to pay too much for stability. But when you look at the transaction costs and the interest rates that people are paying down in Africa, it's pretty high. So like maybe not. Like I don't know how expensive the market has to get for it to not make sense for people. So like if you have to pay 2% a year, 5% a year to like hold Bitcoin, use the Lightning Network and keep it stable, like that's a completely fair trade-off. It's totally worth it. And I think that a lot of people would get on board with that. But I don't even think that's like the biggest idea. I think the biggest idea is that like people are always talking about microfinance in Africa. And it's like, okay, cool. Like Lightning Network can help with microfinance and small payments and stuff like that. But at the end of the day, Africa has a capital problem. They need people to be investing more money in Africa. So like what I think is interesting is that if we think about if we remove Bitcoin and everything from the picture and we think about this from like traditional markets, it's like a lot harder through those avenues. What I could see is that like if we did have something like what I'm talking about with like stability pools and this ecosystem built out down there, that creates this very seamless way for capital to start moving down to Africa. So like if some sort of, I don't know, envision a microfinance like yield product, and there's a bunch of people in the US who are like, oh cool, I'll throw money into that pool. Like they're doing all these investments and maybe it totally blows up and doesn't work out. But I think it's interesting because like it could actually be like an interesting avenue to attract capital to things that had not existed before, and it could create a funnel of capital. So I think like that's kind of compelling. And when you pair that with this idea of like emerging capital markets native to this system, I think that's also a really, really big idea. And when we think about, everybody talks about, like store value and medium of exchange for Bitcoin. Unit of account's a huge deal. Why is the US dollar the global reserve? Unit of account. That's the most deeply entrenched form of monetary function you can have. Once you get set into that, like you're good. So like if we start using things where that stability pool concept, that's just like, the initial application of it. But all it is it's contracts being set up to track an asset price and settling between people. You could track any publicly traded price with that. You could turn Bitcoin into a reserve for a bunch of any sort of publicly traded asset category. So like, that's pretty compelling. Like we could have like a lot more capital markets in Bitcoin to achieve like a reserve function. That's a really big deal. That could create a lot more scale in it. That could make it a lot less volatile. So like there's a ton of different things. These are all very long term.
Yeah.
But like that's kind of what I'm seeing is potential here. And it doesn't have to be people in mud huts. It doesn't have to be, a bunch of maybe it centralizes, right? And that's one of the key risks I see with Lightning. Is it's a state channel system. It requires a ton of liquidity. So when we have a benefit of scaled liquidity, Lightning has a natural incentive to centralize over time. And maybe it doesn't become too centralized, but Ecash doesn't. In fact, Ecash starts to work less as it scales. It makes more sense to keep those types of systems smaller at a federated level. Does it work at scale? Yeah. But like, I think that the Ecash systems, when we look at it from a systemic view, if we had a system of federations all over the world, it's still at a systemic level would maintain a pretty decentralized state to the degree that we would need to keep this permissionless like we would in a self-custodied world where everything's peer-to-peer. It would still kind of maintain that property. Whereas if everything starts going into like Lightning service providers in the long term and none of these other technologies emerge, it could get pretty centralized. Yeah. And like that's kind of scary to systemic level.
I don't know why Fedimint wouldn't also centralize, because let's say we had our own little federation in here, and to then interact with other people, we need that market maker in the middle. Now, if there was a huge one run by like big companies, the fees for those for the market maker for them would presumably be much lower because of the added trust, as opposed to just some randoms who have a federation. Now, if you're then trying to like interact with other federations, that's going to cost more every time that I want to transact with, say, PubKey user. Like one of these big company federations, and I need to swap my Ecash out so I can interact with them. Every single transaction is going to cost me more because I'm in a smaller pool with less trust. So does that not lead to more people just joining the pool that has more trust with these market makers, because then every transaction in your entire life becomes a little bit cheaper?
Right. So I think you're just describing, would Lightning just be used instead? Or would you...
Or just one larger federation?
Yeah, which is there's certainly possible. Like there could definitely be like a very large federation that's utilized for that purpose. But I think at the end of the day, you still have like a scale. There's limitations to scaling on the custodial angle. So that is something that will probably remain small over time because of how trust is kind of like optimized within a smaller community level. If that makes sense.
It does. But so is there like a maximum size for a federation to be like? Is there an optimal size?
Oh, no. Well, it's I don't think there's like an optimal size, right? Like we're looking at a technology and applying it to different use cases, right? So like there could be an optimal size for your family. There could be an optimal size for your broader community. There could be an optimal size for a commercial like institution, like what you're talking about. There's like a lot of different ways that it could build out for different functions.
But then the smaller you are, the more it costs you to interact with other federations.
Yeah, so not necessarily. I mean, you could just say like, I want to use Ecash to privately transact intra-federation. And if I'm interacting with other federations and I think it's too expensive, then I can just pay them with Lightning directly. I still have a Lightning wallet and I still have an Ecash wallet.
So it's going to come down to, it's a bit like right now, I have a multi-sig cold storage wallet. I have two single hardware wallets, which have got a small amount of Bitcoin for day-to-day stuff. One for the football club, one for what Bitcoin did. Actually, I've got a personal one as well. And then I also have like a couple of Lightning wallets with like I've got a variety of things. It feels like I might also have some Ecash within like Fedimint, within some federation that I use for other transactions. So there's like the different bits that you start interacting with for different reasons.
Right. And the point is to have it like in a wallet technology to where this is automated enough, because like the way that we're talking about it at a fundamental level, it seems like really complicated. But like if it's automated enough within a wallet, a good comparison is like, your Bitcoin cold storage or in a multi-sig or whatever it is. That's something that would be like your long-term savings that you're putting a lot more effort into for like self-custody potentially, or maybe that's done through a community. But with like Ecash, it's like, I mean, it's called cash for a reason. It like actually works. It's like on your phone. So it's working like you have like cash in your wallet, and like you're probably not storing all of your money in cash. You're using that for day-to-day transactions when you're walking around or whatever it is, or you're paying your buddy or something. So like that's another way that you could think about it in terms of the comparison. Like you'll have different systems that you're using for optimizing. Maybe when you're paying on Lightning, where you know it's going to somebody over in China who I'm going to have to go through a router, a Lightning gateway or something, maybe there is a high enough fee to where you care. In which case, maybe you're just using Lightning through your wallet to make those payments and you're not using Ecash.
So like the way Moon obfuscates like a lot of that complication away, where this can be on-chain or Lightning, there'll just be an additional thing that is also obfuscated away. And
Right.
you just kind of pick the cheapest way of paying every time.
Right. Like once again, this is all prospective, but yeah, I think that, that's
sense.
definitely how it could work. Yeah.
Huh. Okay. I still don't entirely buy federations, because like the other thing I'm thinking about is like, okay, say Eric, I'm like him, you know, we've had some beers. Oh fuck, by the way, I haven't actually paid for that food.
No, I paid for it.
Oh, did you?
Yeah.
Huh. So I owe you some Ecash.
Yeah.
So we're like, but so like I want to pay Danny, and like I go to pay him. It's like he has a different Ecash.
Yeah. And that's where like the Lightning routing piece of it comes in.
But I
that's
don't
all
want,
automated.
Yeah, like I don't want to know any of this, right? I just want to
Yep.
go. So what if the federation he's part of issues 2-to-1 Ecash, because that's just the way they want to do it, whereas mine's 1-to-1 against Bitcoin.
So there's two incentives for that, right? Like there's the incentive of federation. This is just like a broader idea of like, what's the incentive for fractional reserve banking? Like there is an incentive that, and this is something that I think could also be a vector that makes the system more attractive. Like what made crypto so attractive? Because they were able to create seigniorage through token issuance, right? It's a similar concept. It's the exact same economic concept to like fractional reserve in a certain sense. Like you're creating a new monetization that you're able to leverage because it's costless for you to create. So like there could be, and this is why what I see as an incentive for like a potential for fractional reserve, there's an incentive like, why would I want to join a federation and use their Ecash? Because I can get a cheap loan. Or because there's some sort of like rate of interest that's attractive to me about that. And like you could see economies start forming around that. The question is it sustainable?
Hold on, we're going into the world of free banking again.
Exactly.
But why did the world of like free banking led to central banking? Because of run on the banks, right?
Yep.
And so aren't we just recreating something that kind of broke?
Right. So like, and that's where I, kind of back to the last recording we did. It goes down into a lot of theory around like what regulates a free banking system. And when we think about these systems, we have precedent from like the 19th century. So that's something that was a very different system. It wasn't as competitive. Information wasn't as transparent. It was much easier for these things to be controlled. When you apply that theory to this digitally native system, the game's kind of changed quite a bit. Things are a lot more incentive. Information's much more transparent. We're using a base layer monetary asset that can be withdrawn into self-custody and traded peer-to-peer, at arm's length transactions. So like that changes the incentives of the whole game. The reason that these systems centralized in like free banking was typically because of government encroachment, where they use scapegoats like, fractional reserve banking destroyed this. You need us to help you so that we can do the exact same thing. And eventually we're going to turn it into fiat money, 20 years later. So like that whole scheme was more, it's a lot less possible to occur. Like Bitcoin being an immutable monetary base layer, it eliminates the possibility if Bitcoin monetizes that we would have fiat money again. And then the question is, if we have a banking system built out and it's like a free banking type system, will that be so centralized that, it ultimately destroys the system? Well, the market can determine that. As long as people can opt into peer-to-peer trading through whether it's like base chain or through Lightning, then it ultimately is something that will prevent that system from ever getting to the central bank level. But I don't think the technology could prevent it from getting to like a fractional reserve level yet. There's arguments. There's things like when you go into like what prevented it, you had like certain parties, like you had clearinghouses, which was the primary thing. And those emerged because competition in free banking was very high, and different banks would attack each other by buying up a bunch of their notes and redeeming them all at once and trying to put their competitors into insolvency and then acquiring the market share of their competitors. So like that was happening more frequently, like when a free banking system emerged. And then because of that, like we had clearinghouses step in that were kind of like netting the payments between all the free banks in the middle, and they were membership based. So you had to have a reputation to become a part of it, and you had to abide by certain practices. You couldn't do crazy shit and be a part of it. If you started doing that, you get kicked out of the membership of the clearinghouse, and that was a huge cost to you because clearinghouses were very helpful. They made it a lot more efficient. They would net payments between everybody. They would set interest rates. They would help. It was kind of like this. It was the private market solution that central banks were, ultimately used to say, no, government should control that cog in the wheel that like kept everything together. So like those were helpful and they're reputation and membership based. If we have a system that's very efficient, I see a lot of ways that like if we have a free banking system emerge, putting Fedimint aside, whatever the technology is, I see a lot of ways that we'll have certain functions that are very parallel to that. Like the proof of reserves topic, that's just like a reputation-based form of information transparency that people are trying to create. So like we'll probably have an institution that emerges that's similar to a clearinghouse or multiple institutions that are like standards. If we have a free banking system, they'll say, okay, if you want to be a part of this, then you could use, say this federation that has this stamp of approval from, whatever the proof of reserve company is or the clearinghouse type functions. We'll have these guys that are monitoring, they're tracking, they're like potentially auditing, they're requiring federations to like report Ecash issued. And that would probably be for things that are like higher scaled, that has like a large customer base where moral hazard is much like greater of a risk. So like that's one thing. But the primary thing that I think is really interesting, that could like make the system potentially very efficient to the point where we may not even see fractional reserve is because, with things like the Lightning Network being able to create transaction throughput so rapidly at such a low cost, we have this like very efficient mechanism for trading. And I think that we'll probably see a class of like solvency speculators on the system. So the point about how competitors would try to put each other into bankruptcy, it'll be like a lot easier to put a fractional reserve institution into bankruptcy, because when we look at technologies like that emerged in DeFi of like flash loans, where it's like if there's a publicly traded pool of liquidity and we have a verifiable way of creating an arbitrage trade, then you could actually take out a loan that would instantaneously allow you to loan that entire liquidity pool. So what does that mean? We can create arbitrage trades with very high ability to leverage those trades, which means you could probably put a fractional reserve bank out of business really quickly and easily if you could scale the loan to a certain size. So like that would make fractional reserve just hard to run in a private market. And the reason that that would exist is because you could make a lot of money putting these things out of business and then shorting them. So like that is much more long-term, right? That assumes that there's an ability to short a bank that is a federation and has some sort of publicly traded token security, whatever it would be. But that's an example of something that I think like the system would just be very efficient in a digitally native way. People always have the ability to opt out into peer-to-peer self-custody if they want. So like that puts checks and balances on the system that just have never existed before. Like in old free banking systems, like what are you going to do? You're going to go carry your gold around and like, lug it. And like some people probably did do that.
Is it almost like a financial system singularity?
Ooh.
Do you understand what I'm trying to get to at that point? They're like,
there's the title.
That's kind of badass.
But you understand what I'm getting at with when I say that,
right? We've reached a point of efficiency to where all of we've hit the singular. I don't want to say perfected, but we've optimized for it
because we have ultimate transparency, we have ultimate arbitrage, we have massive liquidity. So everything just becomes so efficient that any fuckery gets exposed or just gets traded out. So there's no because a lot of the fuckery that happens in the system is because it's kind of hidden.
Yep.
Like hidden, like let's look at what happened in 2008 financial crisis, right? That happened. One of the many reasons it happened. One of the large reasons was the AAA ratings of these essentially junk bonds.
Yep.
You wouldn't have this because everything is just transparent and open. And every arbitrage opportunity would close.
That's an interesting point. I mean, I don't want to go that far. It's still that I wouldn't call it the singularity. It's like if we got a curve, we're getting up the curve. But
just much more efficient.
Much more efficient. It's just a lot more efficient. There's a lot more information transparency. It'd be much more competitive, and the ability to exit the system exists. Like that's a key innovation of Bitcoin is the ability to exit our financial system. Basically means pull your money out in cash and try to operate in an online digital world with that.